Welcome to the Real Estate Deep Dive with Paul D. Garrison from JP and Associate Realtors. I think we all can agree that this year's real estate market has been anything but normal. In today's Real Estate Deep Dive, we're going to be talking about two key metrics to watch. The first is new listings. We know listings are going to be a key driver in the market because they impact prices, they impact sales, they impact just about everything. New listings equates to supply in this market. We've discussed the importance of new listings in previous deep dives and recently touched on why in 2021 it's very hard to forecast when new listings are going to peak for the year. We also touched on three possible scenarios around this. The first of the three scenarios is they will continue to rise and help meet the currently high buyer demand. This will provide greater options for buyers and reduce the upward pressure on price appreciation. We'll likely see a reduction in the number of multiple offers as well. We've already seen a glimpse of this with a slight uptick in the past few months. The second scenario is that new listings stay relatively flat. This will still help to alleviate some of the upward pressure on pricing if buyer demand wanes due to seasonality or other forces like rising interest rates, etc. The third scenario is where listings actually start to drop. This means that supply will remain tight. We will likely see continued upward pressure on prices as buyers are forced to compete for the limited options that will be available. In the previous deep dive, I also covered on three reasons why I think we're going to actually see more of this between the scenario 1 and 2 for the fall and the winter. Those are simply pent-up seller demand from the pandemic. We're actually starting to see new construction taking off quite a bit, where we're seeing more and more new homes that are being built. And the end of forbearance is likely to start causing some new listings to come on the market. Not necessarily foreclosures, but again, new listings as people that are in a difficult financial situation start to sell their homes. So let's take a quick historical look at what new home listings have done over the years. So you can see that 2017, 18, and 19 follow a pretty normal trend where they rise in the summer and spring months and fall off in the fall and winter months. Then along comes the year of the pandemic, 2020, and as you can see, there's a dip or a strong drop-off during the peak of the pandemic, but then we've actually had a very strong year that came back, but did start to wane and drop off as we went into the last part of the Q4. Now let's overlay where we are so far for 2021. You'll see at the beginning of the year, we actually had a very low number of new listings coming on the market. That coupled with an abnormally high buyer demand is what kind of stoked the fires and all the price appreciation we've seen this year. And you'll notice that we've actually for 5 months been over where we were in 2020, but still under the historic norms. The last key thing to note is in September. September, we actually dropped below where we were in 2020. This was noted by the chief economist at Realtor.com, Daniel Hale. She was quoted as saying that new listings in September dipping below last year for the first time in 5 months. Next month's data will yield important clues about whether this setback is going to be a temporary or a new trend. As we mentioned earlier, new listings equates to supply in the market. So if this does turn into a new trend and we see supply actually tightening up, then we're likely to continue to see strong price appreciation into next year. Now the second key metric to watch is going to be interest rates. We kind of alluded to it earlier, but if changes in the interest rates can greatly impact buyer demand. And Ali Wolf, the chief economist at Zonda, actually noted this. And she was quoted as saying the single biggest risk to housing is rising mortgage interest rates. She does go on to say that this, coupled with other economic, financial, and confidence challenges, could result in a drop or flattening of home prices, but it will be a far difference from what we saw during the crash or of the Great Recession. So let's take a quick look at the Freddie Mac 30-year fixed rate mortgage rate since the beginning of January to today. As you can see, we've just recently saw a jump in the mortgage rates back above 3%. This is from the impacts we're starting to see where the federal government is stating that they're going to start tapering back their purchase of mortgage-backed securities very soon. Sam Keating, the chief economist for Freddie Mac, noted this when he said many factors led to this increase, including the Federal Reserve communicating that it will taper its support of capital markets, the broadening of inflation, and emerging energy supply shortages, which compound other labor and material shortages. So the issue here is that the economy is recovering, but not quite as fast as they'd like to see. But they are starting to stay. We're going to start to taper some of the support the federal government has been giving to these markets, and that's starting to get priced into the rates. So it's important to note that no one's saying that we're going to see a huge spike in interest rates because of this. But we are going to see, or what most of these experts here are predicting, is we are going to see an increase of interest rates over time. While you'll see some of these are more conservative than others, if we take a look at the averages, we can see that it's going to put us roughly by Q3 of next year around 3.5%. So why is it important if the interest rates go up? Well, it affects buyer demand because it affects their purchasing power. Here's a chart that helps illustrate that. Let's assume that a buyer is looking to purchase a $400,000 house, and the interest rates are currently at 2.75%. That would make their payment roughly for principal and interest of $1,633 a month. Now, what happens if interest rates jump up to 4%? Well, for that same payment, what they can actually afford is a home in the $340,000 range instead of a $400,000 home. So you can see how this will impact not only prices, but also the amount of buyer demand in the market. Hopefully this video has helped show why these are two key metrics to watch and how they provide insight into both the supply and the demand sides of the housing market. Many of the metrics and numbers in this presentation are based off of the national real estate market. However, local areas can vary. Please give me a call and we can discuss your situation. Have questions about your specific needs or location? Please contact me at 214-683-8188 or paul@pauldgarrison.com. Want more information about the housing market and related issues? Be sure and check out my blog at www.pauldgarrison.com. Thank you for your time. Please take a moment to visit our website at www.pauldgarrison.com.